Hello and Assalamualaikum everyone. My name is Auni Shamila. Today, my teammates and I will be presenting a short summary of an article titled AirAsia X Capital Emerged to Set Transform Air Travel Again, says Fernandez. It was published in the Age Malaysia Weekly. Let's start with the background. Capital A was under PN17 status, which means the company was in financial trouble. To fix this, they planned a merge with AirAsia X, which is AAX. It was sister company. The 6.8 billion deal with combined short haul and also long haul, which is flight services under a new company called AirAsia Group Berhad, which is AAG. Now for the summary. First, the merge is expected to create a stronger airline group, with a target of 170 million passengers by 2028 and 377 aircraft. Second, the stock market reacted positively. Share prices of both companies went up after the announcement. Third, the move helped Capital A recover financially and allowed AAX to grow using a lease model that does not require a lot of capital. In short, the merge is a big step to save Capital A and improve the future of both airline business.
Now, I will present the key statistics regarding our aviation outlook and merger impact. Firstly, the merger value stands at 6.8 billion ringgit, reflecting a significant strategic move for consolidation and growth in the market. Next, on fleet expansions, we are projecting an increase in the number of aircraft from 249 in 2024 to 377 aircraft by 2028. This expansion will support road growth and increase capacity for passengers across domestic and international sectors. For passenger targets, by 2028, we aim to carry 17.5 million passengers, which will position us strongly within the regional aviation markets. The growth rate we are looking at is 11.3% CAGR, showing a steady and healthy growth trajectory over the coming years. Lastly, in terms of market response, we see positive signals, with AirAsia X AAX showing a 30% plus increase and Capital A reflecting a 5% plus increase in market confidence following this strategy. This statistic collectively indicates a strong outlook for our expansion, operational efficiency, and market competitiveness. Thank you.
Now, let's walk through the rational decision-making process that was applied in this case. We start with strategic decision-making. This decision was led by top executives, including Tan Sri Tony Fernandez. Their leadership was crucial in steering the organization through uncertain times by making bold, well-calculated choices. Next, we have financial restructuring. As part of this process, liabilities were transferred to AAX, allowing Capital A to strengthen its financial position. This step was essential to ensure long-term sustainability and financial health. The third component is identifying alternatives. Multiple options were considered carefully, from merging and restructuring to asset management and operational mergers. These alternatives were weighed based on feasibility and potential impact. Lastly, data-driven forecasting played a key role. Plans were formulated based on realistic metrics such as fleet size and growth size. For instance, an 11.3% compound annual growth rate or CAGR was factored into this projection, ensuring that strategies were grounded in data rather than assumptions.
Hi everyone, I'll be explaining the problem-solving method used in the AirAsia X and Capital A merger. To overcome Capital A financial distress and operational inefficiencies, the management applied three main strategies. The first, internal restructuring. Capital A sold off its short-haul airline business, which is allowed it to reduce liabilities and focus on recovery. The second one is a business realignment by merging with AirAsia X into one group, AirAsia Group Berhad. They remove structural barriers like the outdate 4 hours rule. This unification made the airline more efficient and scalable. And the third one is a data-driven forecasting. The merger plan includes a future projection like increasing the flight to 377 aircraft and transporting 117.5 million passengers by 2028. This shows the company is planning ahead with a clear, measurable target.
Now, let's highlight the key strengths of the article that support this decision-making process. First, it is both detailed and informative. The article thoroughly explained the merger, including important financial details like the 6.8 billion ringgit deal. It also outlined growth projection and the broader corporate strategy, giving readers a clear understanding of the situation. Second, the article demonstrates a strong strategic vision. It clearly communicates the goal behind the merger, such as resolving PN17 status, expanding fleet size and boosting passenger numbers. All of these efforts are aimed at ensuring long-term sustainability and efficiency for the company. Finally, the article relies on credible sources and quotes. It features statements from key executives like Tan Sri Tony Fernandez, as well as insight from industry analysts. This combination adds both authority and balance to the reporting, making it a reliable source of information. Together, these strengths help provide a complete and trustworthy picture of the merger impact and strategic value.
Let's look at the weakness of the article. Firstly, the merger heavily relies on a lease model, which can be risky due to unstable interest rate. Secondly, there is a huge debt burden. After the merger, liabilities increased sharply from 1.5 billion ringgit Malaysia to 23.27 billion ringgit Malaysia. Next, the profitability of Capital A's non-enride business like logistics and fintech is still unclear and unproven. Also, AirAsia X has limited aircraft and destination. Despite having a strong brand, there is also operational risk. Managing medium and long-haul low-cost flight is tough and risky. Lastly, the execution risk is high. The merger success depends on many factors, including government's approval, shareholder support, and overall market condition.
Today, I want to talk about real-world comparison. Similar to American Airlines and US Airways merger, this case illustrates how large airlines merge to strengthen their market position, manage employee integration, and handle operation challenges during the merge process. Number 2, reflect post-COVID global airline consolidation trends. It reflects the trend of airline merging post-pandemic to improve financial stability, expand route network, and recover operations after COVID-19. Number 3, demonstrate OBM350 concept in real practice leadership. This case shows how leaders play an important role in handling change, supporting employees during the merge, and ensuring the company continue to run smoothly.
In conclusion, this merger is a case study in how businesses apply strategy and financial tools to manage organizational challenges and drive long-term growth. Show how theory OBM350 applies in real business. Demonstrate use of a decision-making models and restructuring. Reflect strategic leadership during crisis recovery PN17 status. Real-world success story in corporate transformation.